Happy Friday, everybody. RJ Baxter here, Fairway Independent Mortgage with your Friday market update. And this week I have a very special market update for you. I'm going to share with you a 2019 economic forecast. And this is information that I'm sharing that was actually something that I saw from an industry expert named Barry Habib. And Barry has a service that I subscribe to called MBS Highway that helps us to track what's happening with mortgage rates from day to day so that we keep track of things that might influence rates to go up and down, be aware of changes that might happen throughout the course of a day even. And Barry is an industry expert who is very well known for being good at forecasting what's going to happen. His forecast from 2018 was scary how close it was to what actually happened. And Barry was just actually named the top real estate forecaster by both Zillow and Pulseonomics. And this is a survey of 150 economists and companies within the survey. So very well-respected industry expert. And I'm just going to share with you what Barry had to say about what he thinks is going to happen in 2019. So let's get started on this. So we have a lot of dynamics happening in 2019, obviously, as a lot of you are aware. We have the trade war with China happening. There was some news just this morning, as a matter of fact, on that, if you didn't see it, that China may extend some aid towards the trade situation, and that's actually boosted the stock market today. The economy's slowing. We have the stock market pullback happening. The Fed, they're indicating that they'd like to hike rates twice this coming year, so we'll see if that happens. And they're also trying to unwind the balance sheet. So what does that mean for mortgage rates? Rates set to rise in the year ahead. How much will they rise? What will the impact be on the economy? And housing appears to be slowing. So we're going to talk about that. And also, inflation is likely to rise as oil prices rebound and with wage pressures. So all these dynamics are happening right now. So let's get into more of the nitty-gritty about what's happening in some different sectors. So first of all, the stock market has been super volatile lately, up and down, but with a more normal market, and the Fed has stopped buying mortgage-backed securities. So in other words, what they started doing after the housing crisis in 2008 is they started buying up the bonds that back mortgages, and that's what kept interest rates so low for so long. But that also led to more stability in the stock market. So the Fed is completely pulled out of buying mortgage-backed securities, and that's a big reason why the market has turned more volatile since October. That's when they completely got out of it. So stocks will likely continue to be choppy and volatile because of this. It's likely that stocks will still continue to struggle here early in the year, but Barry is predicting that they're going to find their footing as we head into 2019. And he thinks we'll end up between 5 and 8% up on the year as a whole. As the stock market rises, here's the other thing to consider is this pressures interest rates, meaning interest rates tend to go up when the stock market goes up, because the reasoning is that money goes into a riskier asset like the stock market, but then they pull out of safer investments like mortgage bonds, mortgage-backed securities. So when there's less demand for mortgage bonds, interest rates rise. But the thing that's interesting that Barry said is even though rates are forecasted to go up, it's likely that housing will actually rebound because of what he calls the wealth effect, which this is part of why we've seen a slowing here in the housing market over the past couple of months, because you may have seen this in your own investments, but as people see that their investment balances are going down because the stock market's doing bad, it's a psychological effect that people tend to pull back from buying a home or making a large purchase like that. So as this wealth effect goes the other direction, people see their investments doing better, it's likely to help housing. The Fed this year, another thing that's going to add to volatility is every Fed meeting where the Fed typically where the Fed does raise rates, if they do, And they also announced other economic policy. Every Fed meeting is going to be televised live now, which is interesting. So this is going to likely increase speculation and volatility. The Fed dot plot, which is a survey of all the people on the Fed committee, shows that they're likely going to hike rates twice in 2019. Inflation should rise as oil prices rise and wage pressures continue. The Fed is scheduled to reduce their balance sheet by $50 billion per month. In other words, they are trying to reduce the amount of money on their balance sheet, which is going to add pressure to the market. The Fed, his prediction is the Fed will hike one time to get the federal funds rate to 2.75, which would put the prime rate at 5.75. They'd love to get to 3%, but he thinks they might struggle to do that second rate hike. The Fed stays the course on balance sheet reduction. And when the Fed signifies that they're going to pause on rate hikes, he thinks this is going to be a catalyst to cause stocks to rally because it's going to put confidence into the markets. Because interest rates can have a dragging effect on the economy. So when the Fed says they're going to pause, his prediction is that stocks will rally on that news. Interest rates. Inflation is a big driver of rates. So as inflation ticks higher, rates are likely to increase as well. A lot of states are increasing minimum wages. When wages increase, that increases inflation because employers pass that on to the consumers, typically in higher prices on their goods and services. Global quantitative tightening. They're going to continue to allow $50 billion to roll off their balance sheet, and they're no longer buying assets. And this is happening all over the globe, like Europe, for example. So it's not just the U.S. U.S. government borrowing more in 2019, so it's adding more supply to the market. So as they issue more bonds for people to purchase, it's just supply and demand. When there's more supply, that pressures rates up. Stock stabilization will hurt rates. We already talked about that. As the stock market goes up, rates tend to go up as well. And he thinks the 10-year T-bill Treasury note will trade between 2.75 and 3.25 with the high at 3.5. And his prediction is 30-year fixed rates between 5 and 5.5% for most of the year. Right now we're well below 5, closer to the mid-4s, mid to upper 4s. So at the moment, it's a good time to move forward on something before rates go higher based on this. Housing, a lot of negative media right now, rocky beginning of the year. Media is a big driver of people's mindsets buying a home because they hear what other people are saying, and it can cause reactive tendencies as people talk about housing being weak, or maybe we're topping out or something like that. Stocks, again, will stabilize. He thinks there's going to be a spring market rebound in housing. And the bottom line is the demographics are still favorable. There's way more demand than there is supply. And I agree with Barry. I think that housing is not going to be going on a downturn, at least in the near future, because it's just supply and demand. Whenever there's more demand than there is supply, home prices are going to continue to go up, especially in places like Colorado. So this leads to what we call the cost of waiting. And he predicts that housing is going to continue to go up by an average of 3.5% to 4% nationwide, which is slower than before, but it's still going to increase household wealth. And if you look at the appreciation factor plus the fact that a mortgage payment reduces principal by a certain dollar amount every month, and then also the fact that interest rates are likely to be higher as the year goes on, there's a cost to waiting to buy for folks that are on the fence, because the payment on the same house they're looking at now will likely be significantly higher if you look at it 12 months from now, for example. So he's to summarize, he says sales and appreciation moderate slightly, but housing remains healthy. So that's what Barry had to say. So I just wanted to I thought that was a really good market update, even though this is longer than what I normally do, to just take a look at what one of the the smartest forecasters in the real estate business is saying about what he sees coming up in 2009. So I hope that helps you guys out. If you have any questions or want to take another look at your situation, just give me a call in the office. My number's here. You can also email me here, and I'd be happy to talk to you. So you guys have a great weekend, great rest of your day, and thanks for watching.